Okay, this is a quick video on VIX, what it is and what it means. The easiest way to explain VIX is just really to read what it says in Investopedia. So with all rights that Investopedia should get, this is from their website. It just says that the VIX index is the first benchmark index introduced by the CBOE, which is the Chicago Board Options Exchange, to measure the market's expectation of future volatility. It's a forward-looking index. It is constructed using the implied volatilities on the S&P 500 index options, SPX, and represents the market's expectation of 30-day future volatility of the S&P 500 index, which is considered the leading indicator of the broad U.S. markets. The calculations are performed and the values are relayed during the day, blah, blah, blah. So the VIX index values are calculated using the CBOE traded standard SPX options that expire on the third Friday of each month, and using the weekly SPX options that expires on all other Fridays. Only these SPX options are considered whose expiry period lies within 23 to 37 days. Okay, so while the formula is mathematically complex, theoretically it works as follows. It estimates the expected volatility of the S&P 500 index by aggregating the weighted price of multiple SPX puts and calls over a wide range of strike prices. All such qualifying options should have valid non-zero bid and ask prices that represent the market perception of which option strike prices will be hit by the underlying stocks during the remaining time to expiry. So obviously it's a very complicated. But what does this all mean? Well, what the VIX is what we call the fear index. Historically, prior to the pandemic, markets were overbought with VIX trading down around 10. 12, 10, anytime the index got below, the VIX got below 10, we would call the market as being overbought. But it could stay down there for a long period of time, and then we see these big spikes, and this is your fear. So when you get overbought, then you usually get a correction, and then you go into an oversold. So historically, it was under 10 or under 12, let's say, was being overbought, and over 30 was oversold. Whenever these popped up through 30, you would look to be, buying the market, the dips, because the markets were extremely oversold, and those quite often correlated with the McClellan oscillator trading under negative 200, being extremely oversold, and the stocks above their 40-day moving average, probably below 30%. And that's what these spikes were. But then we got to the pandemic, and the VIX popped to 87 or something like that. It's around 87, doesn't matter. And then as the market as the market bottomed in March, and this was the bottom of the market here, in March, the VIX got way extremely oversold. As a matter of fact, the McClellan oscillator was down to 1, and the stocks above their 40-day moving average was at 1%, just over 1%, and the McClellan oscillator got down to negative 280 and I think 320. So hugely, widely oversold, extremely oversold. And then it backed off and, faded as the market corrected. But now we have a new level, it appears. Now this is recent history. So if you go back and you look at the FANG stocks, you'll see that we've had, and good ones to, for example, was Nvidia. This looks just like Nvidia, really. Big basing pattern. So now, for my own personal view, and this may not be the view of the world, but my personal view is if this gets over 30, then the markets have turned bearish and we're oversold. And we see that we got these pops. And if it trades under 20, that's going to be very bullish. But I'm not saying that the market is overbought under 20. I think it needs to get back down into the 10 range. I just think that the markets will turn bullish if this trades below 20 and bearish over 30. But we can see that it's traded in this narrow range for the longest time. And why? Well, because the S&P 500, a lot of those stocks in there are made up of the FANG stocks. And this is exactly the same pattern that they've been in. It's just straight, this big consolidation. So the question was asked, Christopher Richard asked, well, shouldn't we be thinking that the market is overbought when the volatility index gets to 20 and oversold when it gets over 30? I don't think so. I think the other indicators wouldn't support that view. This is the fear and greed index. So at 20, it's historically had been neutral, and I still think that that's a neutral reading. It needs to get below 20 to be very bullish. Now, maybe the mindset, or maybe this spike here has changed the algorithms that traders, the big institutions and such, ETFs and funds, maybe the algorithms have changed now to make 20 the baseline and 30 the top line. But I don't think it correlates that 20 means that we're overbought. I believe that under 20 means we're really bullish. And it gets down to 10, then it's going to be overbought. But until it does, this is not an indicator to decide whether the market is overbought or oversold. I think you have to watch the McClellan oscillator to give you a better idea if you're overbought or oversold. This just is showing the market's expectation. And the market expectation at 20 is that it's just going to continue to trade sideways, as it has in here. It hasn't. If you were overbought at all this time, you would think that the market would correct that situation, but it didn't. The FANG stocks have all just been basing in here with the VIX at 20. So it just means it's a neutral market, and all those stocks are very neutral. And then we got, then we did get some spikes, of course, here just before the election. It got up to 40. That was oversold, and that corresponded with the McClellan oscillator getting down to negative 200. Yeah, negative 200. So that was your oversold situation. Those two corresponded. And then we saw that again here. And then we got Powell and Yellen saying buy the dip, and it pulled back. But we weren't ever overbought. We were maybe mildly overbought, but nothing wildly overbought when this is down here at the 20. So, Christopher, I hope that answers your question.